We begin today with the Federal Reserve front and center, as markets brace for one of the most consequential policy signals in recent memory. Fed Chair Kevin Warsh's FOMC is widely expected to hold rates steady at this week's meeting. That much is consensus according to the CNBC Fed Survey. But the bigger story is not what they do with rates. It is what they say. The market expects Warsh to strip the so-called easing bias from the policy statement, eliminating the dovish forward guidance that previously implied rate cuts were coming. That single-sentence change could reshape how investors price risk across every major asset class for months. The CNBC Fed Survey makes it unambiguous. No rate change is coming this week, and no rate change is expected in the near term. What is changing is the language. Under the easing bias framework, the Fed had been signaling that cuts remained a live option, a dovish tilt that anchored forward rate expectations lower. Warsh is expected to remove that language entirely, replacing it with a more neutral or hawkish stance that tells markets rates will stay elevated for longer than previously telegraphed. This is not a surprise hike. It is a controlled hawkish recalibration, and bond markets have already begun repricing in real time ahead of the announcement. Forward guidance is one of the most powerful tools the Fed has, more powerful, in many cycles, than the actual rate itself. When the central bank signals that cuts are coming, long-duration assets rally, risk premiums compress, and equity valuations expand on lower discount rates. Removing that signal does the opposite. It forces every model, every DCF, every bond price to reset around a new terminal rate assumption, one that does not include imminent easing. Today's market is already reflecting that repricing. The 10-year Treasury yield stands at 4.45%, down 94 basis points intraday as traders recalibrate expectations, while the 5-year yield has fallen to 4.17%, down 104 basis points. A dramatic intraday move signaling the front end of the curve is absorbing significant positioning shifts. Let us walk through the transmission. Long-duration bond funds, long-term treasuries, and TLH are the most direct play. If the 10-year holds at 4.45% or moves higher on an even more hawkish Warsh tone, these funds face continued pressure as price and yield move inversely. On the equity side, the Nasdaq 100 is a standout mover today, with the Nasdaq 100 performing well as growth stocks benefit from the fall in nominal yields even within a higher-for-longer regime. The S&P 500 is gaining, with the S&P 500 advancing. The VIX has collapsed significantly, reflecting a substantial reduction in tail risk fear. Financials tracked by the financial sector face net interest margin compression as long-end yields fall, while energy is getting crushed independently, crude prices declining sharply. The single most important level to watch is the 10-year Treasury yield at 4.45%. Analysts treating that as critical support argue that a break below it would signal the market is aggressively pricing in future cuts, essentially calling Warsh's bluff on the hawkish removal of easing bias. The 5-year at 4.17% has already moved significantly intraday, suggesting the forward curve is beginning to embed easing expectations despite the near-term pause. Beyond yields, watch the actual Fed statement word by word. Any residual dovish language, any retention of a cut-leaning phrase, and bond markets could rally sharply while the Nasdaq 100 and growth stocks extend their gains. Conversely, a harder hawkish tone spikes yields and compresses multiples fast. Here is the bottom line. Warsh removing the easing bias is the Fed threading a very precise needle, not tightening, not cutting, but telling markets that rates stay elevated longer than the old guidance implied. That is a Goldilocks outcome in the short term. It reduces tail risk on both sides and explains why equities are rallying, and keeps long-duration bonds volatile without triggering a crash. The risk is that markets eventually force the Fed's hand if growth slows, and that tension does not resolve this week. Watch the 10-year at 4.45% as the orderly repricing line in the sand. That is the complete picture on the Fed's pivotal communication shift today. Coming up next, we turn to a story with major implications for global commodity markets. Shifting now from our first story, we turn to the Federal Reserve and a signal that is reshaping how traders are positioning across every major asset class today. The CNBC Fed Survey is out, and the message from Kevin Warsh's Federal Reserve could not be more direct. No rate changes are expected for an extended period. That single phrase, no change for a while, is doing enormous work in markets right now because it removes the tail risk that has kept institutional investors cautious. The S&P 500 is at 7,546, and the Nasdaq 100 is approaching elevated levels, and the Fed's posture is a primary reason why. The CNBC Fed Survey consensus is unambiguous. Kevin Warsh's Federal Reserve will maintain its current policy rate without cuts or hikes for the foreseeable future. This is not a minor data point. Markets have spent months handicapping the timing of the next move, and that uncertainty has been a persistent drag on valuation multiples, particularly in rate-sensitive growth sectors. Today's survey language resolves that ambiguity decisively toward a prolonged hold. The 10-year Treasury yield has responded immediately, falling to 4.45%, while the VIX has compressed sharply to 16.11, down significantly on the session, signaling broad risk appetite returning to the market. Here is the deeper macro transmission mechanism that most surface-level coverage misses. When the Fed anchors its policy rate with a credible extended pause, it compresses the uncertainty premium embedded in long-duration discount rates. Growth stocks are valued on earnings years into the future. Every basis point of yield uncertainty inflates that discount denominator. By removing the guesswork, Warsh's Fed is effectively handing equity analysts a stable denominator, which mechanically expands present values across the entire growth complex. The 5-year Treasury yield has dropped to 4.17%, compressing alongside the 10-year at 4.45%, confirming the market is repricing the entire forward rate path lower and flatter. The clearest winner today is the Nasdaq 100, up 3.14% as the Nasdaq 100 surges. Technology and high multiple growth names respond most violently to discount rate compression because their valuations are most duration sensitive. The S&P 500 is up 1.73%, reflecting broad participation. Long-term treasuries, the long treasury ETF, gains as the yield curve flattens with the 10-year at 4.45%. Gold futures at 4,360.60 are extending their breakout as real rate pressure eases. The losers are more nuanced. Financials face net interest margin pressure from the flattening curve, with the 5-year at 4.17% squeezing regional bank spreads. The Russell 2000 is underperforming large-cap growth meaningfully. There are 3 levels every macro trader should be monitoring in real time. First, the 10-year Treasury yield at 4.45%. If this breaks below 4.30%, it would confirm a full dovish repricing is underway, but it could simultaneously raise recession concerns that would reverse the equity rally. Second, gold futures at 4,360.60 are approaching the 4,400 resistance level. A clean break there would signal institutional safe haven buying is accelerating alongside the risk-on move, a combination that historically marks late-cycle positioning. Third, the VIX at 16.11 is approaching complacency territory. A move to significantly elevated levels would indicate traders are beginning to question the Fed's messaging consistency or pricing policy divergence risk. The bottom line is straightforward but worth stating precisely. The Fed's extended hold removes the single largest tail risk that has constrained institutional equity positioning all year. With the VIX at 16.11, the 10-year at 4.45%, and the Nasdaq 100 printing a 3.14% session gain, the market is voting decisively that lower real discount rates justify current multiples. The tactical trade is to buy dips in the Nasdaq 100 in growth names while holding long treasury duration through long-term treasuries, but treat the 10-year yield at 4.30% as your stop. A break below that level shifts the narrative from soft landing to something more concerning. Those are the 2 stories that matter most today. Full breakdown is now complete. If this kind of deep dive market analysis helps you trade and invest with more confidence, hit subscribe right now and tap the notification bell. We break down the stories that actually move your portfolio every single trading day. Don't miss tomorrow's coverage.